In Chapter 4, you are focusing on adjusting entries. Adjusting entries is a special part of the accounting cycle and is required based on at least three rules in accounting. One rule is called periodicity, where the life of a company or a business can be reported in periods, example, monthly, quarterly, or annually. And then there are two others, the revenue recognition principle, which requires that all revenue be recorded in the period in which it was earned, whether cash is received or not, and expenses be recorded in the period in which they were incurred. This is called the expense recognition principle, or you may hear it referred to as the matching principle. So, what exactly is an adjusting entry? It is an accounting entry, not a transaction, made periodically to ensure compliance with the revenue recognition principle and the expense recognition principle. I listed here examples of the major types of adjusting entries. And by the way, adjusting entries are not the same as error correction. If you make a mistake and you correct it, that's not an adjusting entry, that's an error correction. One popular type of adjusting entry is the usage of assets. Let's say you bought some supplies at the beginning of the period, and by the end, you have used half or a portion. You would want to adjust the asset to take out the portion that was used up, which is now an expense. Or it could be prepaid insurance. You paid for 12 months of insurance or 15 months of insurance, and here you are 9 months later. You want to charge or record the expense portion of the 12 or 15-month payment that was made. Another popular type of adjusting entry is accruals. Accrual occurs whenever you have an expense that has been incurred but payment has not yet been made. For example, you have employees who have earned their wages, but the pay period is after the close of the fiscal period. Alternatively, you can have revenue that was earned but has not yet been received. This you will not come across in Chapter 4. You may see it in a subsequent chapter. And then there is deferred revenue, which would be revenue that you have received the funds, but you have not yet earned the money. Or, yes. And then you have deferred expenses where you have paid for the item, but you have not yet incurred the cost. And then the final category is what we call estimates. And this popular example would be depreciation. You bought an equipment and you're going to use it for 5 years, and you decide that every year 1/5 of the total cost is going to be recorded as an expense. There's a whole chapter that we could have on depreciation. I think there's an appendix in one of your chapters that deals a little bit with adjusting entries. One last thing before I go into the show me problem, and that is whenever you record an adjusting entry, check to see that one of the accounts you use is a balance sheet account, asset or liability, and that the other is an income statement account, revenue or expense. And finally, an adjusting entry will never involve cash. So if you are tempted to use the cash account to record an adjusting entry, you know that you are doing something wrong. This is the problem that we have, problem 4B, which is similar to the one that has been assigned. They gave us the unadjusted trial balance. This is a trial balance before any adjusting entries have been made. And then they tell us what needs to be adjusted. You will see that we have expired or used up insurance. This is the example that I referred to where you have used up an existing asset. Here are two regarding estimates. We have a piece of equipment that we're using over a period of time, and we estimate how much of that asset we have used up, and we record that as an expense. And then the next one we have is an accrual. The employees have earned $585 of wages, but they will not be paid until after the fiscal period, and so we have to record it now since that cost was incurred in this current period. The last one is similar to the first in that we have an asset, supplies, and we used some of it, and it says that we have 120 remaining. If you come back up to the trial balance, you will see that the total is 246 that was originally bought, and of that amount we have 120 remaining. So the next step is to go to this special tool called a worksheet. The worksheet would be similar to you taking out a piece of scratch paper and doing your work on that paper before you enter it into your final answer sheet. Well, the worksheet serves a similar purpose for accountants. It's not a substitute for the actual financial statements. It provides us with a place where we can make the entries, see if they are correct, and then we formally record them in the ledger. This is called a 10-column worksheet because it has 10 columns, 2 for the unadjusted trial balance, 2 for the adjustments, each one, of course, debit and credit respectively, 2 for the adjusted trial balance. So you can see the adjusted trial balance is the trial balance after adjustments have been made. And this is going to be the column. These are the columns that you will focus on in preparing the financial statements, which are the income statement and the balance sheet. And no, a balance sheet does not have debits and credits. However, it does have accounts that have those balances. So these balances were given to us in the problem, and you will notice that the adjustments are numbered. So for the first adjusting entry, which would be A, it says expired or used up insurance, $380. And so for item A, we decreased by crediting $380. And of course, we now have an expense for the amount for $380. You can see that there. The next one we have is depreciation, where we are reducing the original cost of the asset and creating an expense for the amount that was used. And so in this case, for item B, you will notice that I'm not entering the credit directly into the asset account. We want to keep the original cost of the asset intact, so we know at all times how much we paid originally for that asset, and we instead use what is called a contra asset to accumulate the depreciation. So this account tells us the total amount of depreciation that has been recorded to date. And so we're adding another 1,950, and you can see that now the accumulated amount is 3,428. So if I compare this number with the original cost, the difference between these two will be my book value, or the value on the books. It doesn't mean I can sell it for that amount, but at least it gives me an idea of what the remaining value is to the business. We do the same thing for the other depreciation. Again, credit to the accumulated depreciation, and you debit the expense account that is so titled. So it's called depreciation expense, whereas the contra asset is called accumulated depreciation. And then the last one is, the second to last one is wages accrued. So the employees have earned the 585, which means that the business has this expense, but we're not paying them at this time, so we have a liability. And so what do? We record the expense. You can see that the 585 is debited to an expense account called wages in this case. And since we haven't paid the employees as yet, we have a payable, right? We have an amount to be paid in the future, a give, if you will. And so we have a credit to wages payable. The worksheet is set up so that once you make a debit or credit, it automatically shows you the new balance. And so when we credit 585, there was nothing here. And so you see my new balance is now 585. Once you're finished with all of your adjustments, you should now have an adjusted trial balance that is also in balance. And this adjusted trial balance is the source for all the financial statements that you are going to prepare. Again, we have a quick snapshot of the financial statements. Here is your income statement. It shows that when you prepare the actual financials, you should show a net income of $5,179, and our balance sheet should also balance because total debits equal total credits. And so you go next to the actual journal entries. So all of these journal entries are taken directly from the adjustments column of the worksheet. So you can see, again, all of these would be done at the end of the period, debits and credits. And then we go to the actual financial statements. Again, the income statement is prepared using the information taken from the adjustments column, or in this case, you can go directly to the income statement of the worksheet and take your revenues, take your expenses, and of course, you notice the net income is the same as we saw on the worksheet. Then there is the statement of owner's equity, which takes the beginning balance from the worksheet. You add the net income that we just calculated in the income statement, deduct the drawings taken from the worksheet. We now have our ending owner's equity, and this balance is going to go over to the balance sheet as the ending balance for the owner's equity. The final piece is the balance sheet. And of course, you know it's called a balance sheet because it should balance. It has all the assets. Again, these are taken from the balance sheet column of the balance sheet columns of the worksheet. The debits for these assets, the credits for the accumulated depreciation. So we have our total assets. Then we took our liabilities from the worksheet, and of course the ending balance from the statement of owner's equity. I hope this helps you as you work on your chapter 4 assigned problem, which is similar to the one that we just reviewed.